Let me tell you something that nobody in the financial media is going to say out loud. The people who just sold gold aren't smart money. They are the exit, and the people buying it right now, quietly, systematically, at scale, are the ones who print the actual money. Think about that for a second. The world's central banks, the institutions that literally create currency, are trading their paper for gold at a pace we have never seen in recorded financial history. And some analyst on CNBC is going to look into a camera and tell you the trade is over. That's either stupidity or it's a lie. Either way, you deserve better than that. I've been in enough boardrooms and enough back-channel conversations to know that what gets said on television and what actually gets done with serious money are almost never the same thing. And right now, the gap between those two things is enormous. So today I'm going to walk you through what's actually happening, why it should genuinely concern you, and how to think about what you do next. Not what to buy. I'm not your financial advisor, but how to think, because that's the part nobody teaches you, and it's the part that actually makes the difference between building wealth and just watching other people do it. Here's where I want to start. Gold dropped about 20% from its highs. Big number. If you owned it near the peak, that hurt, and the moment it dropped, the headlines went predictably insane. Gold crashes. The rally is over. Time to move on. And you know what happened next? Regular investors panicked. They sold. They locked in their losses. They moved on. And the central banks of the world, the people managing the national wealth of sovereign nations, they kept buying, didn't flinch, didn't pause, didn't hold a press conference to reassure anyone. They just quietly kept accumulating at a pace that would make your head spin. I want to give you an analogy that I think actually captures this perfectly. Imagine a neighborhood, good bones, great location, solid fundamentals. A house there is genuinely worth $500,000. Then the flippers show up. Suddenly it's bidding wars and weekend open houses and people paying $700,000 because they heard someone paid $650 last month and they don't want to miss out. That's not investing. That's musical chairs. And eventually the music stops, the flippers leave, and the house is back to $500,000. Now here's the question. Does that make it a bad house? No, it makes it the same house it always was. And the serious buyer, the one who actually studied the neighborhood, actually looked at the foundation, actually planned to live there for 20 years, that person is thrilled because the noise left, the price makes sense again, and they could buy more. That is exactly what happened with gold. The momentum traders piled in, prices got stretched, rubber bands snapped back, they exited screaming. And the central banks who never bought because of momentum and don't sell because of headlines, they're still there buying because their reasons for owning gold have nothing to do with what happened to the price last Tuesday. This is the first thing I need you to understand. There are two completely different types of buyers in any market. There are structural buyers and there are momentum buyers. Structural buyers have a reason rooted in fundamentals of policy. Protection, long-term portfolio construction. Momentum buyers have a reason rooted in the price going up yesterday. And those two groups behave completely differently when prices fall. One of them panics and leaves. The other one says, great, it's cheaper now. Every time you see a scary headline about gold crashing, I want you to ask yourself one simple question before you do anything. Did the structural buyers stop? Because if they didn't, you're looking at noise, not a trend change. And right now, the answer to that question is an emphatic no. So why are central banks buying so aggressively? What do they actually know? Because these aren't impulsive people. These are the most conservative money managers on the planet. Their entire job description is don't screw this up. They manage national wealth across decades, across political cycles, across crises. And a survey just came out, publicly available, anyone can read it. Most people won't, where they basically told us everything. 45% of central banks said they plan to buy more gold in the next year. That is the highest number in the history of that survey. To appreciate how dramatic that is, let me give you the trend. Back in 2019, only 8% planned to buy more gold. By 2022, it was 25%. And last year, it was 43%. This year, it jumped again to 45%. And these aren't just intentions written on paper. For 4 years straight, Central banks have bought over 1,000 tons of gold per year. They doubled the pace of buying compared to the previous decade, and they are putting their money where their mouth is. But here's the part that actually got my attention. They asked these banks why. Why do you hold gold? And 9 out of 10, 90% said the same thing. Gold's performance during a crisis. Think about that. The most conservative financial institutions in the world, the ones whose job is literally to protect national wealth, are essentially saying, we own gold, because when everything else breaks, gold holds. 2008, markets crashed, banks failed, people lost their homes, gold went up. The pandemic markets cratered overnight, gold went up. These central bankers have studied every financial crisis in modern history, and their consensus conclusion is that gold is the thing you want when the world goes sideways. But there's something new this year that genuinely surprised me when I read it. For the first time ever, geopolitical instability has overtaken inflation as the central bank's #1 concern. For years, inflation was the thing keeping these people up at night. It's their primary mandate to keep prices stable. But this year, it isn't inflation at the top of the list. It's a geopolitical risk. Wars, sanctions, trade conflicts. 80% of central bankers now say geopolitical instability is a major factor in their decision-making, more than inflation, more than anything else. That tells you something real about where we are in the world. We're in an era where the financial system itself is being used as a weapon. You sanction a country, you freeze their assets, you cut them off from SWIFT, and every central bank that isn't in the inner circle of Western allies watched what happened to Russia's reserves. $300 billion just locked up overnight, and immediately had a very uncomfortable conversation in a very quiet room. The question on every central banker's table right now isn't how do we get better returns, it's how do we make sure what happened to Russia can't happen to us. Now I want to talk about something that I think is genuinely underappreciated, and it connects directly to you and your money. The United States government is spending more on interest payments on its debt than it spends on its entire military. Read that again, slowly. More than every aircraft carrier, every fighter jet, every base in every country, every soldier on every continent combined. We are talking about $1 trillion a year just in interest, and it's growing. I've been in business long enough to know what happens when a company's interest payments start eating the business, and I've seen it up close. You're not investing anymore. You're not growing. You're just servicing the debt and hoping something changes. And the terrifying thing about a government in that position is the options for getting out of it are genuinely bad. You can raise taxes, you can cut spending, or you can inflate your way out, meaning you let inflation run hot so that the debt becomes worth less in real terms. None of those are good options. But the third one is the easiest politically. So that's almost certainly what happens. And here's where it gets specifically relevant to gold. You've probably heard the conventional wisdom. When interest rates go up, gold goes down. And that sounds logical. Why own something that pays nothing when you can get 5 or 6% risk-free? Except it's wrong, not sort of wrong, fundamentally wrong. Because what actually matters isn't the interest rate you see on the screen, it's something called the real interest rate, which is just the interest rate minus inflation. If your savings account pays you 3%, but inflation is running at 5%, you are losing 2% a year in real purchasing power. You just can't see it because the number on your account statement keeps going up. That's the trick. And negative real interest rates when your money in the bank is actually losing value in real terms are historically some of the best conditions gold has ever had, because people start looking for something that at least holds its value. And gold has done that for 5,000 years. Right now, we have a government that cannot meaningfully raise interest rates without blowing up its own debt payments. We have inflation running hot, and we have a Federal Reserve that is essentially trapped. Wall Street knows it. The central banks of the world know it. And 3 out of 4 of them, 75%, told us directly in this survey that they expect the US dollar's share of global reserves to decline. They're not predicting it, they're planning for it, and less dollars typically means more gold because you've got to put that money somewhere. And there isn't a clean alternative. If you want to go deeper on all of this, the mechanics, the historical precedents, what it actually means for how you position your own money, I put together a full breakdown at 90dayplaybook.org. It's a free session, no credit card, no catch. Just a real conversation about building an actual plan for the next 90 days. Because information without a plan is just anxiety. And you deserve better than anxiety. Links in the description. Let me tell you about the part of this story that almost nobody covers. And when I first saw the data, I genuinely stopped and read it twice. Because it's one of those things where you think you know how the world works, and then you realize you've been slightly wrong about something important. Most people assume that when a country says they have gold reserves, there's a vault somewhere under their capital city full of gold bars. That's not really how it worked for most of the last century. For decades, the world's gold has been stored in a handful of Western institutions: the Bank of England, the Federal Reserve Bank of New York, the Swiss National Bank. These were essentially the world's safe deposit boxes. Every country trusted them. Park your gold here, it's safe, perfect track record, no worries. Except something dramatic is happening right now. Countries are moving their gold home in just the last year. Almost 10% of all the central bank gold in the world moved to new locations. That's roughly 10 times the normal rate of movement. The Swiss National Bank, for a long time, the preferred custodian for the world's gold, saw their stored holdings cut nearly in half in a single year. And the really striking detail is that half of all central banks refuse to answer the question of where their gold is currently stored. Just decline to say when the most conservative financial institutions in the world start being deliberately secretive about where they keep their physical reserves. That is not a small signal. And it's not complicated to understand why, when Russia invaded Ukraine, the Western response wasn't just military support for Ukraine. It was financial warfare against Russia. $300 billion of Russian central bank reserves were frozen, just locked, gone from Russia's ability to access effectively overnight. Now imagine you're the central bank governor of any country that isn't firmly inside the Western alliance. You watch that happen. You had your meeting, and you realize that if your gold is sitting in a vault in New York or London, it isn't really yours. It's yours as long as your relationship with the United States remains friendly. The moment that changes, all bets are off. So countries are bringing their gold home, not as an investment decision, as a sovereignty decision, as a national security decision. And when you see that kind of behavior, when sovereign nations are making strategic decisions about physical asset custody at that scale, you're looking at something much bigger than a trade. You're looking at a fundamental restructuring of how the world thinks about money, trust, and risk. Here's where I want to spend a minute being direct with you about something that often gets overlooked in these conversations. The question isn't just whether gold is a good asset. It's whether you understand what you're protecting against and whether your current portfolio actually addresses that, because most people have portfolios that were built for a world that is rapidly changing. They own stocks, maybe some bonds, maybe a house, and that worked great for 40 years of globalization, stable institutions, and generally declining interest rates. We are not in that world anymore. The emerging market story is a piece of this that I think is particularly interesting. The countries buying the most gold right now aren't Western nations. It's India, Brazil, Poland, China, and dozens of others. Half of all emerging market central banks said they're going to buy more gold. Half. And these are the fastest growing economies in the world. These are the countries where the economic energy is, and they are all independently arriving at the same conclusion. We don't fully trust a financial system that can be weaponized against us by another country. We need reserves that are nobody else's liability. One central banker, and I'm paraphrasing here, said something along these lines: we want to diversify away from the dollar, but there aren't many alternatives. So we're buying the best alternative available, which is gold. And that's the thing about gold that keeps bringing serious people back to it. It isn't anyone's currency. It isn't anyone's debt. It isn't backed by any government's promise. There's no counterparty. Nobody can freeze it if you own it physically. It doesn't require a good relationship with Washington or Beijing or Brussels. It just is what it is. And it has been that thing for 5,000 years. Through the fall of every empire, the collapse of every currency, every war, every crisis, that track record is undefeated. Now I want to be honest with you about something because I think intellectually honest conversation is the only kind worth having. Does this mean gold is going to double next month? No. Does it mean it can't go down further before it goes up? No. Short-term gold prices are heavily influenced by hedge fund positioning, options markets, COMEX traders, and a whole ecosystem of people who are just moving in and out of positions and don't care at all about the basic fundamentals. That's just how markets work. The fundamental demand is real and it's growing. The structural backdrop is about as compelling as I've seen it, but markets can remain irrational longer than any of us can. Remain patient. And anyone who tells you they know exactly when things will move is either lying to you or lying to themselves. What I can tell you is this: the conditions that would cause you to want exposure to gold dollar, losing purchasing power, geopolitical instability, negative real interest rates, loss of confidence in Western financial institutions, those conditions are not going away. They are, by most measures, getting more pronounced. And the world's most conservative money managers are responding to those conditions by buying gold at record pace and moving their physical holdings to places no one can freeze them. That's a data point worth taking seriously. I want to take a second here and talk about AI because it's impossible to have any investment conversation right now without it coming up. And I have a very specific view on this that I think is worth sharing. I'm not anti-AI. I've invested in technology for 30 years and I understand better than most people how transformative and genuine technological shifts can be. But I've also seen this movie before, and the pattern is remarkably consistent across generations. In the 1800s, railroads were the AI of their time. Revolutionary technology, a genuine transformation of an entire economy, completely justified excitement about the future, and most railroad companies went bankrupt. The technology worked, the investors got wiped out, the people who made real money were the ones who bought the assets for pennies on the dollar after the crash. JP Morgan cleaned up. The true believers who bought at the top got educated at enormous expense. In 2000, the internet was obviously going to change everything, and it did. Completely, profoundly, in ways we couldn't fully imagine at the time. And investors who bought at the NASDAQ peak in March 2000 waited 15 years to break even. 15 years. The technology was real, the valuations were insane, and those two things can absolutely coexist. I'm not saying AI is a bubble. I'm not saying sell your tech holdings and go hide. What I'm saying is that stock valuations right now are at levels we've only seen a handful of times in the last 100 years. And those handful of times did not end particularly well for the people who were fully exposed when things were corrected. Meanwhile, 80% of the world's central banks said in this survey that they have no plans to increase their equity exposure, zero interest in stocks. They're buying gold, not because they hate technology, because they're managing risk across decades, not quarters. And risk management at that level has a different kind of credibility than a talking head on television telling you to buy the dip. So let me bring this all together because I want to leave you with something you can actually use. The world is moving from a system built around one trusted reserve currency and a handful of trusted institutions into something more fragmented, more competitive, and more uncertain. That transition is not a blip. It's a structural shift that plays out over years and decades. And in that kind of environment, the assets that win are the ones that don't require you to trust any particular government or institution. They're the assets that have value across systems, across currencies, across political alignments. Gold is that asset, not because of some mystical property, because of a 5,000-year track record of being that asset to every single version of this same story. Empires rise, empires fall, Currencies inflate into worthlessness, new powers emerge, old powers decline. And through all of it, gold maintains, not always in a straight line, not without volatility, but directionally across meaningful time horizons. It is the thing people reach for when trust in system starts to crack. What does that mean for you practically? It means you should at minimum understand what you currently own and what it actually protects you against. Traditional portfolio theory suggests somewhere between 5 and 10% in gold. Some people with higher conviction about where we're headed are running that number higher. Some people are at 0, and if you're at 0 and you haven't thought carefully about why, that's the first conversation worth having with yourself. Think about what you're actually protecting against. If it's dollar debasement, gold is a direct hedge. If it's a stock market correction, gold historically holds or rises when stocks fall significantly. If it's geopolitical uncertainty and the possibility that the rules of the global financial system might change in ways that disadvantage American investors, gold is one of the few assets that genuinely doesn't care about any of that. And then think about how you'd own it. Physical metal, ETFs, miners, because those behave very differently from each other and serve different purposes. But more than any specific allocation decision, what I want you to take from this conversation is a framework. When you see a scary headline about gold, ask whether the structural buyers stopped. They haven't. When you hear someone tell you the trade is over, ask who's still buying. It's the central bank of the world. When you see market pricing as a perfect outcome for AI and technology, remember railroad stocks in 1880 out of 80 and NASDAQ stocks in 2000, not to be paralyzed by those comparisons, but to hold them somewhere in your mind as a counterweight to the narrative everyone is currently being sold. If you want to actually sit down and build a real plan based on all this, not just understand the information, but translate it into decisions that make sense for your specific situation, join me at 90dayplaybook.org. It's a free 2-hour session, and I'm going to walk through exactly how I'm thinking about positioning for the rest of 2026. Not a sales pitch, not a teaser, an actual working session where you leave with a framework you can use. The link is in the description below. Here's how I want to close this, because I think the most important thing isn't any specific insight about gold or central banks or the dollar. The most important thing is that you start treating your financial education with the same seriousness you treat anything else that matters in your life. I'd made a lot of money. I've also lost a lot of money. And the losses almost always came from the same place, from not understanding something well enough and letting someone else's confidence substitute for my own knowledge. The financial industry profits enormously from you not knowing things, from you feeling like this stuff is too complicated, too technical, too much, just let the professionals handle it. And then the professionals handle it in a way that benefits them first and you second, and you find out about it 20 years later when it's too late to matter. The central banks of the world are making moves right now that are telling you something, not whispering it, telling you clearly with data, with purchasing behavior, with physical gold moving across borders. Whether you choose to pay attention to that is entirely up to you, but you should at least make that choice with full information rather than with whatever the television decided to cover this morning. You don't need to be a finance expert. You don't need a degree in economics. You need to be curious. Pay attention to what serious money is actually doing rather than what it's saying in public, and build a framework for making decisions that holds up under pressure, because pressure is coming for everyone. The only question is whether you're prepared for it or whether you're figuring it out on the way down. The structural buyers haven't stopped. The smart money is still in the building. Make sure you understand what that means before you decide it doesn't apply to you.